Hi, my name is Mingi. Today I want to present about Goldman Sachs. This is the chart from the Yahoo Finance. This is a Goldman Sachs group, and then it represents over 2 years stock price. So as you can see, like they started from around 120 to around 190 as of yesterday. And also there are a few things I believe they're drivers, which is I think first of all, I just got this data from the Bloomberg. As you can see, the operating profit is average for their competitors is 25%. At the same time, Goldman Sachs has 34%, which is incredibly higher than other competitors. So this is competitors I choose. Basically, they have a large asset size, and then they're trading globally. So that's the reason why I choose the competitors. And then also here's the few things I wanna talk about today. So first of all, I saw loan amount has been increased since 2013. That increased the earning of the company. So for the commercial banking side, is 65% of the commercial banking is coming from the loan. So loan demand has been increased. That means it affects their net income directly. So at the same time, there is another thing which is called net revenue in the investment banking side has been increased from the 15.4 billion to 26.8 billion. So it's the same period of time they have a increase around like 1 billion it in the size of the EBITDA. So it helped the increase of the net income, which is earning of the company. So at the same time, their demand for the financial advisory increased for their their revenue. I think that is coming from the S&P 500. This is the S&P 500 graph from the Yahoo Finance also. So for the over 4 year, S&P 500 performed better than previous year. So with that in mind, they increased the financial advisory into the financial institute. So that increased the net earning of the Goldman Sachs. So the next one is the revenue in the institutional client service increase in the fixed income, currency and commodity client execution. So they increased net revenue in the institutional client, which for the big companies, and then in the currency market and also the fixed income, they increased their net earnings as well. The next one is the investment management brought in the large portion. Their management side, they had more profit. It's about they increased a lot more. So in that way, the total asset under the supervision increased about 8 billion to 1.1 trillion. So it's about I don't know, like 60 times of the previous year. So as their asset under supervision increased, their commission fee could go up. So as a result, they could have a better year for the earning side. The next one is equity and debt. Under the underwriting, income increased 1.1 billion. So they're sometimes doing the IPO for the companies, and they also doing the issuing debt, and they make sure they can help those companies. So for that aspect, uh, the underwriting increased 1.1 billion. So it helped them a lot to for their earnings as well. So they usually they go to the small companies, not super small companies, but the companies who could go to IPO, and they help them to the IPO. So in that way they could have some margin from the company when they do successfully. Uh, I think this is a huge as well. The short-term interest rate increased, so because in the commercial side, the interest differences make a lot margin in the commercial banking side. So their short-term interest increase effective their earnings a lot as well. And also United States GDP increased 1.9 from 2013 to 2000 from 2013 to 2014. Actually 2012 to 2013. Yeah, it helped them to have more money into their market, so in that way they could have more commission fees. The other driver was the swap dealer and derivative regulation worried on in the future, because right now the government think they are too aggressive on the derivative, so and the swap dealer. So that's why they put some regulation. It kind of limits the earnings because a lot of people are afraid of the risk of regulation, and so that's the kind of bad side of the earnings for the Goldman Sachs. And also operating expense stayed flat while net income increased. This is great because when from 2011 to 2013 their operating expense stayed as the same, and then 2011 it was like 22.6 billion, and right now it stays about the same, 22.4 billion. Actually decreased a little bit, and the revenue increased about 6 million. So that's great increase when they're managing their operating expense. So that's a good side for the company. And then I look at the valuation table. So right now this is the valuation from my calculation at the Excel. It shows their P/E ratio is relatively low because average is 17. Even like even P2 is 11. At the same time they have 10. So I think it's a good sign to invest in, because relatively it's cheaper than their competitors. And then at the same time, if you look at the PEG ratio, it's kind of a lot, because their earning per share increased about like 0.00%. So the PEG ratio affected a lot. But at the same time, if you look at the P/E ratio, it's relatively low. I think at the same time they're paying a lot of they have a lot of earnings for their companies. So I think still PEG ratio says they're overvalued. You shouldn't too much worry about it. And we could look at the right here. It shows it's from the Bloomberg. It's the competitors have a relatively similar market cap size. The P/E ratio is 11.3. Currently Goldman Sachs only 9.9. So PEG ratio says a little bit is in the average of the industry. So I think this is time to buy Goldman Sachs, and then this is my presentation. Thank you so much.